Welcome to Finance in Excel video number 86. Hey, if you want to download this workbook for Chapter 9, click on the link directly below the video and scroll all the way down to the Excel Finance class section. Oh, in this video here, we have a comprehensive example of how to estimate future cash flows. This example will include everything, including the kitchen sink, at least in regards to this chapter, Chapter 9, in our textbook. We will consider different units sold for each year over the life of the project. We'll do maker's depreciation. We'll sell the asset and look at the tax implications, everything. All right, here's our assumptions. We have an idea to sell a new drill, right? We have this great new idea. This drill is going to be better than some of the competitors' models. Here's all the assumptions. All right, $90 is the sell price. But price decrease after year 4, right? Competition comes in, so we have to reduce our price after year 4 to 80. Here's our projected sales for each one of the 8 years. Variable costs start off at 55, but after 5-year costs go up, so it goes up to 60. Total fixed cost each year are estimated at 35,000. Net working capital requirement at the start of the project, 15,000. As we talked about 2 videos ago, right? When you start a new project, you're going to have some extra cash for that project, some extra inventory, some extra accounts receivable associated with this project, accounts payable also. So net working capital, very important. And if we increase the number of sales over time, or it's changing, wouldn't it make sense that net working capital would change also? So we're going to assume that for each year, net working capital will be 17% of our sales, estimated sales. Initial cost is 1.1 million. We're going to use Maker's tax law depreciation. We have industrial equipment. We're going to sell the equipment at the very end of the project. We're going to assume that the value will be 10% of the original cost. We'll sell it for that amount. Our tax rate is 34, and our required rate of return is 0.2 or 20%. Now let's do a couple of calculations. First, right off the bat, if we're using Maker's industrial equipment, we got to go look it up, see what the class is. This should say class here. So we're going to go over to example 7. We just did this one 2 videos ago. And it looks like industrial equipment is going to be 7-year. Now we're actually going to have to use this table right here. These are our percentages. Let's go back over to example 8. So I'm going to put 7-year here. Might as well calculate right now our selling price in 8 years. Who really knows what it's going to be? But we've estimated it, original cost times 10%. And let's also do the taxed implication at the moment of the sale. Now here's the deal. We're using Makers, and Makers for a 7-year class. If we look at this table, boop, right here. Oh, yeah, it always depreciates it down to 0. So in year 8, after we take that depreciation expense amount during year 8, the book value will be 0. So that means if we sell it for 110 and the book value is 0, it's a gain. So we have to take this this amount here and subtract out the tax. So we're going to do times, open parentheses, 1 minus our tax rate. All right, so that means the cash flow in will be less than this because we have to pay taxes on it. Boom, there it is. All right, now let's get to the bulk of this. There's going to be a lot of calculations, and actually we're going to have to move back and forth between our assumptions and our table. And this table goes way over here, right? Lots of calculations. All right, units, no problem. I'm going to say equals this. Estimated these units throughout the life of the project. Unit price. Oh, look at this. We have 2 different ones. Now we're going to build an if statement here, link to these. So if we change this to 3, right, then it'll change, right? We can see right here, these should all be 90. These should all be 80. So we're going to build an if statement, equals if. And the logical test is going to be, hey, year, whenever you are greater than 4, and I'm going to have to lock that with the F4. Well, what's the price if it's greater than 4? We get down here, 5 is greater. Well, it's going to be this one. F4 to lock it. Whoops. Let's do that again. When it's greater than B2, and then I hit the F4 key. That's the logical test, comma, then the value of true, $80, F4. Otherwise, the value of false, that means if it's less than or equal to 90. Now, if we build this formula and we mess it up, we'll copy it down, and we'll see that it didn't work, and we'll edit it. Control Enter, double click, and send it down. Looks like it's working just fine. There it switches. All right, total sales equals units times sales. Relative cell reference, so we Control Enter and copy it down. Now I'm going to do the same thing. Change the column width a little bit like that. Do the same thing for variable cost, right? Starts at 55. After year 5, it goes up to 60. So say equals if this one right here is greater than 5, F4. Then what do we want? We want this price right here, F4. By the way, could we have built this differently? You could have said less than or equal to, and then the value of true would have been there. But nevertheless, we did greater than, so that was the $60. Otherwise, this one, F4. That's the if function's great because you can put one of two things into this column, and that's what we want, with a trigger being for us 5, so greater than 5, and sure enough, all of these are 60. All right, now I'm going to scoot over here. Total variable cost equals units times variable cost. Fixed cost equals, that was given. We estimated that in advance right there. So I'm going to say, click on that cell, and then I'm going to hit the F4 key. What's great about the F4 key, it'll jump the screen back into view. Control Enter, double click and send it down. Oh, depreciation. Well, we have, let's just look at this, 1 to 8. And now before we build our formula, let's go look on this sheet number exercise 7. Look at these rates are exactly in the same orientation, 1 to 8, right? So we can build a formula on this sheet, example 8, and our formula can actually look over to another cell reference right there. So let's go ahead and do that. Equals, oh, but what's the oh yeah, the original cost every time, right? As we saw in our last video. So that one, and I'm going to hit F4. So all the way down, for this tax method, the definition is always use original cost times. And now, usually in this class, we have just gone and gotten a cell reference here in the sheet. But what are we going to do if the cell is over on this other sheet here? Well, all you got to do is, within formula and edit mode, click on the sheet. Notice immediately that it puts in example 7 in little single apostrophes with an exclamation point. That exclamation point says you're doing a sheet reference. Click on the first cell, and notice it's a relative cell reference. We're not going to lock it because we want it, as we copy the formula down on this other sheet, we want the cell reference here to move down. Now I'm going to hit Enter. Do not click back on the sheet or it will ruin your formula. Make sure you see example 7 exclamation point F10, and then hit Enter. You can click right there. You can see that formula is working. I double click it and send it down. F10, it should be, if we click on this last one, sure enough, it moved to F17. All right, EBIT equals total sales minus the sum of our expenses. And we have 1, 2, 3. Total variable cost, fixed cost, depreciation. Close parentheses. Control Enter. There's our EBIT, given a bunch of different assumptions about units sold. Also price. We have the price that changes. And I'm checking it to see if it works. Sure enough. Now taxes equals round. I think in the last video when we did the makers selling the asset, I forgot to use the round. But as we said, that's all estimation anyway. But we're going to use it here. The number, oh yeah, EBIT times and our tax rate. Now I'm going to scroll way over here and all the way down. There's our tax rate. Notice we can see it up in the formula bar. I'm going to hit F4, and luckily it not only locks it because we need to lock it when we copy down, but it jumps the screen back in view. Comma, and then 0 for number of digits, close parentheses. 0 says round to the dollar. Control Enter, double click, and send it down. Net income, not considering interest, of course, because we're doing finance calculations here. So EBIT minus our taxes. Now, Control Enter. Notice that EBIT minus taxes, that's our net income here. There's no interest. Double click and send it down. OK, so that's correct. Now, we're almost, that's all of our normal kind of things we've done numerous times in this class, calculating pro forma financial statements. Now we're getting close. Where cash flow analysis will be operating cash flow. We'll have to have the change in net working capital for each period and capital spending for each period, and then we add up the cash flows. But one last thing, we need to calculate our total net working capital that we need each period. These are not the cash flows. We'll calculate the cash flows, the marginal change in net working capital over here. But here we just want to estimate for each period. Because remember, over here, oh yeah, net working capital requirement during each year is 17% of the previous year's estimated sales. And so we've done it this way because our sales in units are changing each period. Well, in times 0, we obviously have our 15,000. So immediately when we start up the project, net working capital is 15,000. And now this one's going to be all of these are going to be a calculation based on the sales. All right, so that, as we copy down, will be a relative cell reference times, and we need to get that 17%. And F4, you can see the formula up there, F4. So this column has two different formulas, one there and one there. So when we copy it down, we'd be sure and copy it to there. Sure enough, it worked just fine. If you scroll over, you can see the blue one is on the bottom sales, and the 17 is still locked. All right, now we get to our cash flows. That's all the calculations we needed. And so we don't need to, in past videos, we'd built a table for depreciation and ending book value. But we, in essence, did our depreciation calculation here, and we already did our ending scenario when we sell the asset calculations here, so we don't need a schedule for there. So now we're off to cash flows. Oh, well, cash flows. Oh, what is it? EBIT minus taxes plus adding back the non-cash depreciation expense. Oh, but remember, net income already has our EBIT minus taxes. So I'm going to say this one right here plus our depreciation. And depreciation is changing dramatically each period because of makers. So we simply Control Enter, double click, and send it down. There's our estimation for operating cash flows. Now, for net working capital and capital spending, we have cash flows at time 0. And we have to think about the sign here. These are all positive. Those are positive cash flows. But here, at time 0, net working capital, that means we have to invest in that. So we come over here, net working capital requirement at start. Enter. Now, this is always going to be an incremental change. If we started at 15,000 at time 0, and then during this year we require that amount, we're only interested in the change, the difference between these. Now notice it went dramatically up. So we're going to need a negative here that shows the difference. But look at down here. And net working capital is related to units. So if you look at units, up, 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 oh, down, 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 down. So that means during these years, if units are going down, our requirement for net working capital is going to go down. So it'll show up as a positive, which we already saw that net working capital gets recovered at the end. Right at the very end, we recover it all. So our calculation is going to be the difference. Now I could just go equals this minus this. No problem. That'll tell me the correct dollar amount that we need. But really, we need this to be a negative because it went up. That means it's a cost, a cash flow out for the consideration in this cash flow analysis. So you can do it however you want. We could put parentheses around it and a negative in front. I think and that will work just fine all the way down. It'll work. I think I'm going to carry the sign in, so it's going to be minus that plus this. So I'm going to go minus this plus that. Either way you want is fine. So you can see negative. We're investing net working capital each period, but here we have this dramatic drop in our requirement. So that is like we are recapturing it. Now the only tricky part here is, remember, we fully recapture the net working capital, or at least we're going to assume that. So this full amount at the end, we actually have to add back into this cell. So I'm going to have 3 different formulas in this column. One there, one here, and then this final one I'm going to have to amend. Add that back in. All right, now we're off to capital spending. Capital spending, I'm going to say minus and go over and get that initial amount, 1.1 million, tab. And the only other change we have in cash flows, oh yeah, we sold it at the end. We've already done that calculation. Tab. All right, so now, wow, there it is. There's our cash flows. Wow, that was a lot of estimating, right? We did all the different little tricks here. All right, and even with all this calculating, right, we didn't go out and do the research, right? We could have looked at internal records and estimated based on other drills we had what the pattern of the life of a product like this is. Or maybe we hired a consultant who went out and did market research. So there's actually a lot more to all of this even than we're doing here. And still, this seems like a lot. All right, I'm going to put the period just so we have our final cash flows and cumulative cash flows for the payback calculation. I'm going to repeat this here. So I'm going to, whoop, because we can see it way over here, right? But I want it right over here, too. Explicitly, when we're doing our net present value, internal rate of return, we have those years or periods. All right, and so we simply sum operating cash flows at time 0, change in net working capital, the cash flow implication, and capital spending. Actually, I could have double-clicked and sent it down. So there's our cash flows. And now we can do net present value. But I'm going to also do my cumulative cash flows for our payback. So equals sum. And we're going to do our trick we did before. We're going to have an expandable range. So I'm going to type a colon. That as soon as you type a colon, it puts that U3 close parentheses. And I'm going to be sure to lock this one. That means that one's locked. That one's not. Double click, Control Enter, double click and send it down. You can clearly see that the range expands each time as we go down, right? All right, so we can see for payback, it's going to be somewhere between 3 and 4. All right, one other thing before we do our net present value. I forgot to do that over here. Just like we did in our last video talking about makers, I want to add all this depreciation up. Because remember, makers always depreciates down to 0. So if we add up all of these non-cash depreciation expenses, we better get the original cost. So I'm going to Alt equals. And sure enough, we do. 1.1 million. All right, here we go. Net present value equals net present value. The rate, I'm going to have to scroll way over here and way down to the bottom. I'm going to hit the F4 key just to jump me back over there, but I'm going to hit it a few other times to get back. We don't need to lock it here. Notice the F4 key toggles through all the different types of cell references. Comma, and our values, we have them right here. Oh, not time 0, time 1 to 8. close parentheses, plus a negative. We're subtracting the initial cost. We have it listed as negative, so I add it. Ding, 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 all that work for net present value, positive 51,000. All right. Now, anytime you get a positive net present value, that just means you should probably investigate further, right? This drill here, you better be able to point to a reason that we're getting a net present value here. Because if it's a competitive market, then it's hard to find positive net present value projects. So maybe we have a new design that solved an old problem for our drill. And so that's the thing we can point to that says why this would be a net present value. Or maybe we have a brilliant marketing campaign or something like that. So we get a positive net present value. That means we pinpointed something. Now we go back and we analyze all of our assumptions over here. We look at all of these, make sure they're reasonable. OK, so we have net present value, positive. We also want to calculate IRR, so equals IRR. Oh, and all the cash flows, including time 0. 21. So the return is 21. Our required return is 20. So if we have a positive here, we would suspect that IRR would be greater. Payback. Now let's look down here. We know it's between 3 and 4. So I'm going to say equals this 3 right here plus some fractional amount. Well, we still have that amount of cash to recoup. And over the next period, we have this cash in. So I'm going to compare these with division. Now that's a negative. So I'm going to put, instead of adding, I'm going to type a minus. So it's a minus minus divided by this. And that'll give us an estimation for payback. So total payback, 3.47 years. All right, that is a lot of fun with estimating cash flows for net present value, for estimating and determining whether we want to accept this project. All right, we'll see you next video.